Hello everybody, San here, engineer, MBA, and investor. And today's video, I want to talk about the breaking news that Teladoc posted their earnings today after market close, and they are currently down, as you can see on the screen, nearly 38% after the market has closed. This is crazy. 38% is unheard of. Okay, guys, it's not like these companies are like 200 billion and they can sort of afford to go this down. They were worth well below 9 billion, and clearly they've been hit so hard after their earnings. And I want to talk about that. I want to talk about their earnings, take a look at it, what actually happened, and hopefully make sense out of everything here. But before we do that, before we jump into today's video, you guys know the drill. Like this video, smash that like button, destroy that like button. If you're not subscribed yet, consider subscribing. So I was notified this by one of our followers here. You know, how do I feel after Teladoc's earnings after 4 p.m.? Obviously, I was busy with other things, and I saw that message, and I was like, wait, what's going on? And clearly here, as you can see on the screen, almost 38% down. I mean, I'm not even going to talk about the stock price at this point. I mean, this has been hit so hard, right? But a couple nice things on Google, actually, they now allow you to look at the earnings financials right from your Google search, right? And from, if we take a look at just Q1 2022, which is what they released today, it looks like revenue came short of expected. So $565.35 million of revenue this quarter that just we went through Q1 2022, as opposed to 569. Again, I'm not really worried about these types of expectations. I mean, it is what it is. I mean, I'm not even gonna spend too much time on how bad these analysts, cover these numbers. Not just for Teladoc, just every other company, right? Just look at Tesla, look at other companies in the space. They always get it wrong, and honestly, it makes sense, right? They're not in business. They're not literally day-to-day operations. What do they know about expectation? Honestly, all they do is just graph out certain values on Excel sheets and just take the median value throughout several analysts and call it an expectation on Wall Street, right? But anyways, so EPS obviously came up just a little bit better than the negative 0.52. So obviously you don't want to be growing that number when you're negative. So that's quite good. But clearly that was not the news for today. Actually, the news for today was actually for the massive impairment charge, right? So shares head towards lowest level in more than 4 years as the online medicine company wipes away more than $6.5 billion in goodwill, right? So when I saw that, I was like, wow, okay, what is going on here? That is a huge number, right? That is a huge number. And if we take a look at this sentence here, Teladoc XZU did not disclose much about the goodwill impairment charge in Wednesday news release. But according to the company's filing SEC, this is actually coming from the Livongo acquisition. And I just read from the other article that the Livongo acquisition, only one of those execs from Livongo actually still remains in this company. I think all of them just left the company since it was acquired. So that is a red flag for sure. But again, you saw Tesla do that in the past with specific acquisitions, or I'm not that worried about it. But anyways, this point here, the goodwill impairment was triggered by sustained decline in Teladoc Health share price with a valuation size impairment charge driven by a combination of recent market-based factors such as an increased discount rate and decreased market multiples for a relevant peer group of high-growth digital healthcare companies, as well as updates to our forecast cash flow consistent and the revised guidelines disclosed today. So they did revise guidance. We'll take a look at their presentation shortly. But I do want to mention a couple of things. But before I do head to the presentation from Teladoc officially, this is another article. This is a healthcare drive. And obviously the big news is, again, the impairment charge from the Livongo acquisition. The merger has struggled, resulting in a large goodwill impairment for the charge for the purchase, right? So clearly a huge loss here, and obviously this company is going through difficult times as we speak, not just in stock price, but clearly this huge price decline stock-wise, but also related to this goodwill charge. And from my understanding, I'll be honest with you, I had to look further into it, but from my understanding, this has happened because the stock price went down and that triggered certain things that eventually lead them to this goodwill impairment charge, which is really, really bad. Impairment occurs when the acquired asset no longer generates the financial results that were expected of them at the time of purchase. So obviously, when Teladoc purchased Livinggo, it was at a certain stock price, and obviously certain promises, certain financials were set at the time in 2020. Clearly, this stock has gone down, way down. Well below its 2018 levels, which is well before pandemic, right? So forget about the pandemic at this point. This is like 2018, which is absolutely crazy. So goodwill represents extra money that a company pays to acquire another beyond its value on paper. So that is basically what happened, right? They made certain things, certain promises, and the stock went down over the years. And obviously, this is where we are today. So this is where the goodwill impairment charge comes from. So obviously, that is the big news for today. That is literally the only reason why the stock is so down, because Q1 revenue actually grew 25% year over year, which I think is quite acceptable for a figure of that. That side of the business where we're sort of moving away from the pandemic and where we are heading. I think a 25% growth year over year, quarter over quarter, that over the quarter, right? So first quarter of 2022 compared to the first quarter of 2021, I think it's quite great considering how much they grew in 2021, of course. So you got to remember that, right? So obviously they had to revise their guidance as well a little bit here and there. Not really worried about that, but just visually look at this, guys. Year over year, 25% growth. I think that's good, right? Look at the access revenues, right? 29%, right? Visit fee revenue, 12%. This is not, when you see these types of figures, that does not explain a nearly 40% drop from a company worth $9 billion, right? That was previously worth in the 3 digits billion dollars, right? So that is just crazy, guys. U.S. revenue 24 year over year, international revenue 27 year over year. So sustainable growth, in my opinion. Things are looking good. Look at this, U.S. paid members have been growing. So compare that with Q1 2021, 51.5 million, and now you're at 54.3. You grew a little bit under 3 million, which is, I think, acceptable. Average U.S. revenue, which is what you want to look at. Look at this, it grew significantly, right? This is significant, $2.09 per member, and then in 2022 it grew to 2.52, right? So I think this is great. The key metrics here, you can see utilization growing a little bit here from 17.5% to 23%, so more utilization from members. So again, a lot of presence in the international markets. But clearly the big news here, guys, is, we can talk about EBITDA all we want, but really the big news here is that that goodwill impairment charge, and it is what it is. That's pretty crazy. I'll be honest with you guys. I never expected in my lifetime to see a stock be beat down so much. Guys, I don't know if we can generate the stock price right now, but look at this, guys. This is crazy. 38% aftermarket. Look at this. If you draw it from its peak in early 2021, this company is down well above 80% at this point. With that 38%, this is like, I think, at 90% at this point, right? Dropped down 90% from its all-time highs, and that happened just over a year ago, which is crazy. Currently, they're sitting at around 2017 levels, right? Forget about 2018. I'm talking 2017, guys. This is crazy. It's trading at $34.70. It is what it is. I've said it many times. This market is very volatile. It's an extremely risky market. We saw what happened with Netflix, and forget about genomics and CRISPR companies or healthcare companies. Just focus on the whole broad market, right? So many uncertainties. Tesla went from like $1,000 a share to like 800 something, right? In like overnight, literally. So markets are volatile. Things are really, really bad right now. Extremely high uncertainty, a lot of volatility. But again, we look at the numbers together, and I think things are looking upwards. But obviously, this goodwill impairment charge obviously will happen if you make certain promises when you acquire a company. This is not something new. What is new is that this company at this size dropped this much. I think the CEO here has to be on the hot seat right now. Gorevic, I would not be surprised if something happens. unless the board of directors, they're sort of betting on the fact that the macro environments will sort of shift back in their favor. I can tell you from what I've been seeing, I'm thinking most CEOs are hoping for that. Most board of directors of most companies are hoping for that. So really, really crazy, guys. Hopefully you guys appreciate this video. Let me know in the comments below what do you guys think about the earnings? What do you think? Do you think I'm wrong? Do you think their revenue could have grown a lot more than 25%? Let me know year over year. Let me know in the comments below. Thank you so much for watching. Subscribe if you found value. Like this video, and I'll see you guys in the next video in this bloodbath market. Thank you for watching.